Hey guys, it's Bob Hertzog, your real estate dad. Hey, today I had my good friend Lizy Hoeffer come in to talk about interest rates and what's going on with this war in Iran, the impacts that that's having on rates, as well as we spent quite a bit of time, again, talking about first-time home buyers and some of the options that are out there for them. So you don't want to miss this episode. Thanks for stopping by to watch, and we'll talk soon. Hey, Lizy, how's it going?
Oh, just another day and whatever we're going to call this.
Oh, timing is everything. And we've had this sit down scheduled for a couple weeks now, obviously. And last night, we've been talking all week about what's going on in Iran and everything else. And of course, yesterday, the big announcement came that there was going to be a ceasefire, and we all had hoped for the best, and then we wake up today, and now all of a sudden it doesn't look like we have a ceasefire. Whenever someone asks me, how's the market, that's the biggest question I get. Obviously, I tell them what I'm seeing, but what I'm seeing from a lot of my clients, especially folks that have done business with me in the past, is, it's like, hey, we're just going to sit here for a while. We're not going anywhere until we figure out what the heck is going on. So I wanted you to kind of explain today a couple of things. Number one, what does a war, we've been in a few wars, obviously. We haven't been in one like this in a long time. So a lot of people, this is new to them as far as how it affects the real estate market and mortgages in particular. So I just wanted you to kind of talk about where we're at right now with rates. What I noticed was literally, I think it was the day before we started dropping bombs in Iran, we got down to the 5.99%, and everyone was freaking out. There were signs that we were going to come out of this thing, and all of a sudden, that's what I tell people when they ask me. I said, hey, we were looking pretty good until we started dropping bombs. And then yesterday we got some hopeful news that maybe isn't so hopeful anymore. So talk to me about where are rates today? How much did they go up because of this mess that we've got going on in Iran? And how does a war affect something like interest rate? How does it make its way to interest rates? Because everyone's got those questions right now.
So lots of answers there, right? So first and foremost, the price of a home and your leverage in a market all depends on supply and demand. Mm-hmm. So, and those dynamics are always lagging indicators. So you might be talking to buyers or sellers right now that, we're thinking of buying and or selling that may be on the fence. Mm-hmm. But the dynamics, if you have to sell or if you have to buy, those are already in play for most people that have applied for mortgage. And what you have to consider is that rates are elevated, but they're still lower than they've been in the last 3 years if you're looking from a longer trajectory. Mm-hmm. When you're looking within the most recent 45 days, they've risen over 0.5%, which can seem pretty dramatic. But if you compare this time to last year, rates are relatively, they're improved actually. Mm-hmm. And so what you want to look at is what's impacting the supply and demand dynamics. So for example, the rate at new inventory, and this is a data point for real estate agents, started declining June of last year.
Okay? The rate of what?
New listings that hit the market.
Oh, okay, yeah.
Now that it impacts the amount of new homes that'll enter a market, and then you saw interest rates drop, and then all of a sudden you had a lot of new buyers hit the market, and then you saw, there maybe weren't as many homes. And so that takes a couple of weeks / months to really impact, what you'll see in the market. And so at the very beginning of this year, come February-ish, we started to see bidding wars. Okay. Now that's over almost 6 month change, right? But it takes that long for market cycles to move. And the reason I mention this is because all of this stuff is relatively new, and we won't really see the impacts of this unless the duration goes longer, and then two, that we've had all of these buyers and sellers that are already in movement, that they've gone away. Mm-hmm. Does that make sense? Mm-hmm. So then what'll change is, at 6.5%, unfortunately, just due to affordability, a lot of buyers have to be sidelined because they straight up cannot qualify for a mortgage.
Right.
Okay. So that happens, right? So then you lower your demand pool. Okay. But there's still enough demand to meet the amount of homes that are on the market. Okay. And so then what we should start seeing the longer this goes on is the demand for buyers go down, the number of new listings that hit the market, that percentage go up.
Okay.
Does that make sense?
Yeah.
And
Yeah.
so all of those things, the higher the interest rate, the more leverage you have as a buyer just because you have less competition. So I just want to
Right.
say that just first and foremost, because people like to time the market, but really you want to buy when the supply demand dynamics make sense for you.
Right. Right.
Now, interest rates, like they're all over the place and how they're impacted with the economy. So war per se does not necessarily have any impact to mortgage-backed securities. Okay, but as they impact the economy, you'll see changes in investors and how they move their money. Okay.
Right.
So this Iran conflict impacts the cost of oil, and oil itself impacts the cost of goods, right? Because most everything is imported, exported. And so when you raise the cost of oil, you're essentially increasing inflation, and so and that'll be passed on to the consumer, right? And so everything just becomes more expensive.
Right.
So when things become more expensive, the likelihood of the Fed spiking rates seem to be high in the moment, right? So that was when we saw the first increase in mortgage interest rates,
Okay.
right? The likelihood of the Fed to increase interest rates,
Okay.
and that's the Fed funds rate. That was actually short-lived, right? Because we started getting weaker employment data. We started getting, not so strong inflation data, right? And so they were like, okay, so then as the Fed funds rate spike started declining, right? The anticipation of that, because we always trade in anticipation of, then it started going to, okay, could this be recessionary? Like, could this actually could it be deflationary? And could we lead us into a recession? Does that make sense? So that's kind of where we're living today. It's
Okay.
like this battle between inflation and recession. And so every other day when there's like, oh my God, oil prices are going to spike up, there's temporary fear of inflation. Everyone moves their money directly into the 10-year treasury. And the 10-year, the reason why it impacts mortgage-backed securities is like they don't have a direct relationship. It's just that they're the most similar type of investments.
Okay.
So your 10-year treasury note is like an IOU to the government. It's your guaranteed rate of return. Your mortgage-backed security is a long-term rate of return, typically higher than your 10-year treasury note, except you have to anticipate for early payoffs, foreclosures, short sales,
Right.
people who like miss a payment. So you're guaranteed, it has some risk to it. So that's a lot of the dynamics that are really at play here. This particular situation is going to be really interesting because the longer it has gone on, the more they have anticipated for a recession. And we actually started seeing interest rates improve. So my best educated guess, and this is just a guess because I'm not clairvoyant and I'm not an economist, is that if they resolve things in Iran, it'll take about 6 to 8 weeks for the market to stabilize and to return to normal-ish conditions, right? So we still have to then deal with how this impacts the cost of goods, whether or not we have inflation as a concern, and we just kind of have to cycle through those economics before we really will know where rates will settle.
Okay.
Now, if this goes on longer, what ends up happening is that a high cost of oil will just make people stop spending, and we're already seeing that. Okay, and so if that happens, like one, there will not be a Fed rate spike at all.
There won't be a rate cut.
No, a spike. So when inflation goes up, they typically raise the Fed funds
got
rate.
it. Right.
Right now, it's looking like they're not cutting or they're not increasing.
Okay.
Okay, but the longer that it goes on and the less people start spending, if we start seeing inflation go down, and if it goes down below 2%, what they end up doing is the quantitative easing where they start buying mortgage-backed securities.
Right.
And we already saw that they were buying mortgage-backed securities this year just in general to make housing more affordable.
Okay.
So that's where you get the 3 to 4% interest rates. So while we don't want war, I mean, one of the positive outcomes to it could be that people get another chance at that 3 to 4%.
Mm-hmm. What do you think? I mean, what's the difference in, we got down to 5.99%, and literally the next day the war started, I think, or 2 days later or something like that.
It was like a week.
Yeah. And they've jumped up to 6.5 now, even higher than that in some cases.
Mm-hmm.
What does that mean to someone's payment on a average home sale right now? If say on $400,000 or $500,000 loan amount, what does 0.5% add to their monthly payment roughly?
It's a little under $200.
Okay. But $200 can mean a lot to a lot of people in terms of not just affordability, but can they even qualify, because now that payment is eating up more of their budget, right? Or what
It
they bring
moves
home.
their buying budget at least 5%.
Okay. So when rates drop, say 0.5%, what's the statistic again that a certain amount
at 6%, 3 million people became eligible to purchase due to just qualifications.
Okay. Got it.
Yeah. So just due to qualifications. And so the thing is, and at 5.25, you had a bunch of people, consumer sentiment plus qualifications. They were like, okay, this is a high enough rate where I'd still move and dump my 3%.
Right.
Right. It's low enough to get them to move.
Right.
Right. But it's the highest rate that some people were willing to pay.
Yeah.
And then even then, the data is actually showing that regardless of what your interest rate is, it could have been 2%. If you had a need, like you got married, you got divorced, you had a baby, you had somebody die, you were downsizing, you still moved.
Yeah.
And we're now seeing that the data is showing that we have a larger percentage of people now with over 6% mortgages, right? And I think it almost outpaces people with under a 4%.
Right. Right. Interesting. What I feel or sense out there when I'm talking to people is people that are talking about selling and then purchasing another home aren't doing it because they want to, it's because they have to, right? It could be anything like what do they call it? The 4Ds or the 5D, diapers, diamonds, death, divorce, maybe it's the divorce. Yeah. That these life events are making people sell, but the ones that don't have life events, you're not getting that sense though necessarily. I mean,
but
you're
isn't that
busy
why
right
people
now.
move?
Yeah.
It's because of all of those reasons. Like if you don't have a reason to move, are you moving?
Yeah.
Right? Like my big thing here is that everyone always tries to time the market. They're either waiting for lower rates or they're waiting for a deal or they're waiting for the market to crash. I mean, since I've been in real estate, there's always been something around the corner.
Yeah.
Okay. Now there was the Great Recession, which is arguably the worst thing to happen to real estate ever.
Right.
Okay. And it was due to horrible loans.
Mm-hmm.
Horrible loans and people that weren't actually occupying their properties. So these are people like your school teacher buying 4 different properties that they had no intention of renting, and they were just cash out refinancing them to purchase other properties. Right. And so we don't even have that situation now. Even with the non-QM lending that's available today, people are occupying their properties. They have enough assets for these properties. They qualify for these properties and they're living in them. And people don't typically foreclose on the property that they're living in unless there's just absolutely no choice.
Right. Let's shift gears just a little bit and talk about the first-time home buyers and some of their challenges, and not just their we all know that they have challenges, and people watching this podcast will know somebody that's, stuck, maybe have a kid still living at home at 30 years old or whatever. And they're wondering when those first-time home buyers are going to be able to make a move and not have to rent something. I mean, I drive through the valley now and all I see are apartments, it seems like. I mean, apartments are springing up everywhere right now, and that makes me a little nervous. Like, are we becoming a rental society?
You have to have more affordable housing, period. Again. Like, you need more affordable housing. But the thing is that people are always waiting for, when is it going to get cheaper? And I just don't see how. Like, I just explained why I don't think there's this massive wave of foreclosures. Mm-hmm. The thing is, if you're timing lower interest rates, that's when everyone jumps into the market. And so your first-time home buyers, they're better suited in higher interest rate markets for purchase because sellers are incentivized to pay all their closing costs, to pay the repairs on the property, to pay their agent commissions. Like the most favorable condition a first-time home buyer can buy in is when the buyer demand dynamics are in their favor, meaning that they have less competition.
That's
I
right
mean, a
now.
buyer in 21 versus a buyer in 23 got completely different deals. The buyer in 21, yeah, they might have gotten a 3% interest rate, smoking, but that person paid over appraisal price, over purchase price, paid all of their closing costs. They definitely didn't ask for any repairs. And so
Right.
they walked into their property and maybe had to replace a roof on top of paying all of those out-of-pocket expenses.
Yeah.
And yes, those people are saving $500 to $1,000, but most of their break even is 4 years. And so they finally broke even on somebody that purchased in 2025, right? When you're comparing somebody to 23, like
Right.
that just doesn't seem fair. And the people that bought in 23, a lot of them were able to refinance at mid 5% interest rates recently. Now, or they took advantage of a temporary buy down, which is where the seller uses the closing costs to subsidize lower payments. So, I mean, like somebody buying in 23 wasn't necessarily paying all that much more and definitely less out of pocket. To
Right.
purchase. So the buyer
Sure.
dynamics are in their favor, higher the interest rate.
Right. What kind of lending things are out there for first time? Is there anything special? I just remember back in those days, I wasn't doing a lot with first time home buyers then. I'm probably doing more with first time home buyers now than I was back then. But it just seemed like there were more incentives out there for first time home buyers before the 5% down and all that. I mean, I know you still
There's
have
way more today
Yeah.
than there ever has been.
Yeah.
Like you have a 3% down conventional. That's something of the last like 5 years.
Mm-hmm.
You have your first time homebuyer grants. So many companies have like grant programs. Our company has a $4,000 grant program for first time homebuyers.
Which a grant means it doesn't have to be
Doesn't
paid
have to
back.
be paid back. Yeah.
Right.
You can use it towards closing costs. You can use it for buyer agent commissions. You can use it
Yeah.
for down payment costs. You can split it.
So what are some limitations to those, like the 3%? What are the some things that are unique about that? There's other things that you might have to pay a little more in mortgage insurance, right?
So the conventional loan programs typically, if you, the one restriction is actually the area median income, right? So if you're making $200,000 and you're a first time home buyer, really the only benefit is 3%. Okay, you don't
Right.
qualify for any assistance programs.
Right.
They consider you making too much money, and if you're making 200,000, chances are you're
Yeah.
not going for a 3% down.
Right.
Okay,
Right.
but assuming that you're somebody who makes, I think it's 103,000 or less. Honestly, I'm so sorry, I don't know this about the
Yeah,
top of my head, but you qualify for actually a discounted interest rate, discounted mortgage insurance, and a 3% down. And why this is so cool is that if you're really looking at investing, you want to have a lot of assets and you get the best rates on your primary residence. And so let's say you're a couple, one person can buy at 3%. Okay, 2 years later, the couple can upgrade the property. So meaning both of them can be on the loan. And because one of them is a first time home buyer, they can buy again with 3%.
Oh, wow.
There's like no other asset that you can purchase. Like you can buy a $500,000 asset for $15,000. Like there's just no other asset. And then it doesn't return on your 15,000, it returns on the 500,000.
That's interesting.
So there's a ton of ways to purchase now. And then there's all kinds of down payment assistance programs. Now those programs have higher interest rates.
Yeah.
And down payment assistance is not for free.
Right.
You are paying for it. But again, like I said, you're buying an asset worth like, I don't know, like it's just worth so much more than your cash investment.
Yeah.
And so even if you pay it back, great. It's the cost of entry. I mean, that property, if you own it 10 years, will pay you back in spades. Like most people make, I think it's like $100,000 in equity if they bought a $400,000 property that's returning 5% in 5 years. I mean, most people cannot save $100,000.
Right. So just backing up a second, what you were saying caught my attention. You've got to say it's a married couple and they both have their own income, own jobs. You guys will look at each person. Obviously you'll look at their combined income and debts and all that, but you're saying that in some cases you guys will just put one person on the loan to save that other person's credit and purchasing power for down the road if they can. I mean, you try to get people qualified with just one because both will be on the title.
You
right?
would no only one can be on the title, which is why you need a trust.
Got it.
Like a trust protects your family entity. But the reason you do this is because like a lot of people invest in real estate as a part of their retirement. So you're going to buy your starter home. Let's say you buy your starter home. It's like 300,000. You're putting 3% down. That's $9,000. You own the home for 2 to 4 years. And then you're going to upgrade to a $500,000 home. Okay. If you're putting 5% down, that's 25,000.
Yeah.
Okay. As compared to $10,000 less at 15 if you bought again with your co-borrower who is still a first-time home buyer. Right. And so hypothetically, what you could do is you buy 2 properties with 3%, then your third property you buy with FHA, which is 3.5%, and then your fourth property you buy with 5%. But the thing is, if you retain these properties, they all have the best term financing because they were all primary residences. Okay. If you figure this out within 5 years, they're all capital gains. Like you have an exemption from the capital gains, right? You can sell the first property to then upgrade the next one. And you can kind of have tax-free money that carries with you for a long time. I mean, it's what I did to start investing. I kept upgrading my primary residence. And then I sold my first one within the 5 years of the capital gains exemption. And I invested that money into a more expensive property. And then I have subsequently now just been reinvesting that gain over and over again every 2 to 4 years.
When it comes to first-time home buyers, what's the biggest reason you're seeing them not be able to get a home or get a loan? Is it credit? Is it the income isn't there? Is it, what are you seeing lately?
So it's mostly mindset. Truly, most people will qualify, but if the payment is not in their budget, they just won't pull the trigger. And that makes sense. Like you never want to buy if your lifestyle is going to be impacted, if you can't save for a rainy day, if you can't pay down debt, like you never buy in house poor conditions, right? So I fully agree with that. But most of the time, if like the payment is off by like $50, people aren't going to move. The second barrier of entry is really just the cost. You know, most people don't have the money for their down payment, or they don't have money for closing costs. It's one or the other that prevents them from moving. And they haven't explored a lender that has down payment assistance programs. And then the third thing is their friends and family have told them it's a terrible idea. Or they've listened to, all those doomsdayers about the housing market. I mean, one thing I will say, and I don't know how many people are going to watch, up until this point. But if the person isn't actively invested in real estate, if the last time they invested in real estate was 20 years ago, or they're not an economist or forecaster, they don't have a true opinion to give you. Right. They're not actively investing. They're not actively purchasing. Like this person isn't the best person to get your money advice from. And I cannot tell you how many people are not homeowners that drag other future or potential homeowners away from homeownership.
Or I was thinking about this today. There's so much wealth tied up in the boomers right now. There's so much equity in their properties. They've got so much money, and their kids and grandkids are struggling right now. Maybe it's time for them to loosen up their purse strings a little bit and help their kids at least get a little bit of a start here, right? And dig into a little bit of that equity. I feel like this is this mortgage, this problem that first-time home buyers have getting a mortgage, it's really turned them very sour on just our world and our finances in general in our country right now. I mean, I think it's a deep-seated thing where this younger generation has seen nothing but wealth. They see their parents, owning their houses free and clear. Their grandparents have all this money. They're like waiting for them to die so maybe they can have some of it. But what if we came out with a program the government did that allowed parents, grandparents, whatever and maybe this happens now. I'm not even really sure about this, but allows them to loan money to their kids or gift money to their kids so that they can get going and get into this game before it gets too late. Are there programs in place now? Does the IRS allow? I know there's some gift.
So there's definitely some gift restrictions due to the IRS. I don't know them from memory, but what I would say is that you can always have somebody added to the title, and then it's not considered a gift because it's ownership. So there is that. And the other thing that I would say is there's a lot of different ways to get into a home, when it comes to down payment and gifts from family members. Those have always existed. There's gifts of equity. There's just straight up gifts. And we do see it a lot. I mean, I do see a ton of people who are willing to help their children purchase properties. And then conversely, there's a lot of people who buy properties for their elderly parents, and that's a lot more allowable. So you can actually buy a primary residence for your parents. So
Right.
that's something that's allowable.
Right. Is there a limit, like when it comes to qualifying for a mortgage, that parents or, grandparents, whatever, can gift to their kids without screwing up them getting qualified or anything like that?
No, I mean,
Okay.
obviously the lower the loan amount, the easier it is for them to qualify.
Right. They're still going to have to qualify, debt to income ratio and that sort of thing. But there's not really a tax benefit to the parents or the grandparents for doing that, right? I mean, do you know? I mean, I know you're not a CPA.
I mean, I feel like the big, beautiful bill allows you to gift like $1 kajillion. Honestly, I don't know.
Yeah.
Sorry, I don't know what that is.
Okay. I was just curious. I mean, there's got to be a way to make this easier for these guys. That's the problem.
I think it is easier, to be very honest. I think that there's a lot to say about that generation and then the children that they had, which are the millennials.
Yeah.
You have a situation where a lot of like the boomer generation, they have to age in place because they aren't doing so well financially.
Got it.
And so, and then their millennial children also aren't doing so well.
Right. Interesting.
But your Gen Xers, you guys are doing great.
Yeah, we're doing okay because we were latchkey kids. We had to figure out how to do it on our own. We don't sit around and complain about it. We just go get it done, right?
There you go.
Okay, well, this has been very enlightening today. Thank you for coming in and doing this. The Iran war, I mean, we're all watching it carefully now, and I think the key thing that I learned, you always have to come in and remind me of how that whole thing works with the 10-year treasury and mortgage rates. There's just there's so much conflicting information out there for people. And if you're just reading headlines or just listening to your friends that aren't in this business every day, a lot of times that keeps you from making the decision to go out and buy a house and start.
I think it shouldn't be an interest rate question. Seriously. I think it should just be like, hey, how does this impact my leverage as a buyer seller? That's the question to ask your real estate professional or to ask Bob.
Yeah.
Is just seriously, it's like, hey, how is this Iran war impacting my buyer leverage?
Yeah.
It's like, well, interest rates are up. So when interest rates are up, we can ask for more from the sellers.
That's right.
Right. And that's more the question, because if you're trying to time interest rates, there's so many variables that are outside of our control. I can give you my best guess. I had been saying for months, I'm like, okay, interest rates are coming down. Inflation is regulating, employment is softening. These are the things to watch that will impact people's decision to take the money out of the stock market and to put them in first the 10-year treasury note, second mortgage-backed securities. We already saw that happening for months.
Right.
Then the president came in and then he was going to buy mortgage-backed securities, which just accelerated, right? So normally mortgage-backed securities, a 30-year mortgage interest rate will be somewhere between 1.6 to 1.8 higher than whatever the 10-year treasury note is at.
Okay.
Okay, that's a normal spread.
Yep.
Okay, so it's the difference in yes.
Well, no,
it's over 2% right now.
Yeah.
So it's over 2%. So that's not a normalized spread.
Right.
But it used to be much higher. So if all of this had happened a year ago, interest rates would be 8%.
Jeez.
Okay, and so you can't figure out all of the economics at play. None of us knew that Donald Trump was going to, use Fannie and Freddie's money to purchase mortgage-backed securities. That wasn't in our bingo card this year.
Right.
The Iran war, not on our bingo card this year. And had everything just kept going as normal and that spread kept normalizing, we would have been at 5.75% interest rates right now.
Yeah. I wonder what percentage of people out there, especially the younger generation, the first-time home buyers, are just assuming they can't qualify for a home right now based on what they're reading, rather than picking up the phone.
You mean watching on TikTok?
Yeah.
Instead
of calling you and saying, "Here's my deal." How long does it take to get pre-qualified online? 5-10 minutes?
It takes about 15 minutes to 20 minutes to fill out the application, and then it's normally 24 hours to get pre-qualified.
Right.
But I will say this, it's mostly because the information out there is they're flooding with all kinds of things. Like there's so many people that are like, I don't know what to do.
Yeah.
And there are not enough people like you and me that are saying, you need to do this.
Yeah.
And it's scary, right? Like we say, hey, now's the time to buy. And then all of a sudden interest rates are up.
Right.
So I understand why more people aren't bold, but it's like, you just have to look at what this situation is and then how does it impact your ability to buy or sell.
Yeah.
Like there's always a deal to be had in every market possible. Like the home flippers, when interest rates went up, they were like, great, I can get a home at a discount now.
Mm-hmm.
Okay, when interest rates are at 3%, you cannot get a home at a discount.
Yeah. What percentage of potential buyers out there right now do you think would qualify if they would just make the effort to apply? I mean, do you think there's a large, do you think there's a large percentage of people just literally that don't know? They're afraid to even ask and take that first step.
You know, I don't know, because by the time they're calling me, they've already decided to take the first leap.
Yeah. Yeah.
But I would say that I qualify a majority of the people that I talk to.
That was my next question.
I mean, I don't know what the exact percentage is.
Yeah.
I know it's over 50%.
Right.
So if I talk to you, we're gonna qualify you.
Right.
Now, whether or not people feel like they are ready to purchase, that's a different story.
Yeah.
And that really comes down to who is guiding them through the process. Like if they have a wishy-washy agent guiding them through the process, they probably won't purchase.
Right.
If there's too many hurdles, like sometimes it's somebody's lease, or sometimes it's like they want to save $2,000 more, or sometimes, and a lot of times people, like, they just don't have somebody showing them how they're tripping over dollars to save pennies.
Yeah, exactly. Exactly. And they don't want what we had during COVID, where we had open houses with 50, 60 people lined up down the block to get in to see a house. And literally, I had one where we had 44 offers over a weekend on a house when things were crazy. Interest rates were, 3%. So everyone loved the interest rate. But we had a ton of buyers that quit the whole process because they were sick of getting beat up, and all the competition and the bidding wars to get houses and losing over and over and over again. To me, that was the most frustrating time in 27 years I've ever been in real estate, was having to deal with that many offers. It was just crazy. So I always tell people that if rates drop and things go crazy, it's the old supply and demand thing, right? And do you want all that competition with other buyers, or do you want to just buy the house and then, hope that rates come down someday where you can refinance it, or, you always have that option as well, as you know. But I don't tell people to make their decision based on that, but at least that could happen.
You like, a home is an asset.
Yeah.
Okay. And you can't get wealthy without owning assets, period, the end. Like, you're never going to be wealthy just renting. Like, even if you put all of your money into the stock market, it still doesn't appreciate leverage wise the same way that a property does.
Yeah.
Okay. So it should be your decision to purchase based on your budget. Is your budget, say it's a go? And then next, like, how does this impact my overall financial plan? And when you figure that most people, at least currently right now, because we have a majority of homeowners, 75% of their retirement comes from the equity in their primary residence. Owning a home is not just like a thing you should do. It's essential if you ever want to retire.
Right. And I think Kim and I are on our 12th or 13th home since we've been married, 34 years. And about 3 or 4 homes into it, I remember telling Kim one time, I'm like, and this was before I even got into real estate. I said, the cool thing about owning a home, it's like forced savings. It's like having a piggy bank that you don't even know where that money's growing. And then, because we'd go to sell a house, we were making way more money on the house than we were able to save over 3 years, so it's like the light bulb went off for me. And that's what we did. Just like so many other people, we'd take all of that profit and put it into another home, and, knock on wood, we never got clobbered by anything, but, it was, that's the beauty of home ownership. It literally is forced saving. And the earlier, just like anything else, it's time in the market, not timing the market. So the earlier you can start this process, better. So, okay, cool. Well, thank you again. Always fun chatting with you about this stuff. And you always put it in layman's terms that that people understand. So hopefully we get out of this war and get back on into a normal market, so to speak.
And if we don't, guys, it's supply and demand.
It is what it is.
It is what it is.
Yeah.
People
Cool.
always buy houses.
All right. Thanks again.